Hi, I've got Douglas Isles with me today, who's one of the investment specialists with Platinum. And I thought that it would be a great opportunity to reflect on international equities, given that there has been such strong performance over the last 12 months, 18 months. So really, I think for us, Douglas, there's three pressing questions on our clients' minds. And the first is, performance has been very strong. So, as investors, have we missed the boat if we've got more money to invest into international markets? I suppose part of that is with currency, is the Australian dollar going to stay around these levels or get weaker? And therefore, what's the outlook? And I suppose Platinum is a stock picker at heart. So what are the things that Platinum's getting really excited about?
Okay, we start off with the market and how it's moved and everything. I think there's two parts to this question, Catherine. There's a tactical question, if you like where are we going in the shorter term, and then there's a structural question: how much international exposure should people have in the portfolios? Now, if I address the structural question first, we are concerned that across Australia, people tend to have what we think is too little exposure to international equities. There's a concept or a theory around home bias, which is a problem around the world. People tend to put more money in their home market than they do overseas. One of the key drivers of that is familiarity. But what's interesting in Australia is people have more money here in their home market than pretty much anywhere else in the world. So we have an expensive property market, and many people own their own homes. We have very high wages compared to the rest of the world, which is good now, but may make us less competitive going forward. And then on top of that, we have a very high exposure to a market which is dominated by banks, linking back to property, and resources as well, which have probably had their best days for now. So we're concerned that people have too much in this market. We understand familiarity, we understand there are benefits, tax benefits through franking credits. We also understand that it's been right to be exposed to Australia, and this market's done particularly well, and a company like Commonwealth Bank is probably one of the strongest performing shares in the world over the last 20 years. So I think a lot of people, their first exposure of buying a share has been Commonwealth Bank, and therefore they think, well, I picked that one.
If they were lucky.
If they were lucky, and if they picked it in 1994, it's done better than the US market has done over any time period, Commonwealth Bank, over the last 20 years. So people have this, I guess, perhaps false sense of being very good at picking stocks. So we're just a bit concerned with the balance in portfolios. So regardless of whether you think you've missed the boat short term, I think structurally people should look at that balance in their portfolio.
And what's the right amount?
Well, it's a difficult question. I think the wrong amount is the sort of 60% that people have on average here in Australia. If we flip the question round and we say, if you were anywhere else in the world, what would you put in Australia? And we make up less than 0.5% of the world's population. We make up about 2% of 1% of GDP, 2 or 3% of stock markets, 5% of land, if you really want to build your portfolio in an unusual way. And any of these numbers, plus where we are in the cycle, you'd probably think you want to be less exposed to Australia than normal. Given where we are in the cycle, you wouldn't come up with a number like 50 or 60% of growth assets. So the number, I think, is probably nearer 20, but it's a finger in the air. There's a thought exercise that you need to carry out. When you then look at the short term, I think the driver of the markets in the last 12 to 18 months has predominantly been the US. That's been the strongest market, and coupled with that, a very strong currency. So, when we look broadly at the globe, it's really been a story that America has moved. The rest of the world has yet to join in. So when we look for opportunities, they're dominated by Europe, Asia particularly. We'll come on to that later. But it's a case of saying, the media, the commentary that we are exposed to here in Australia is very American-centric. Mm-hmm. So we talk about our currency, again, we'll come on to that. We talk about our currency in terms of we are 70-something cents, not we are a balance across the countries we actually trade with rather than a country we measure ourselves against. And the same thing happens with the stock market. You hear a lot more about the Dow Jones and the S&P than you do about the local market. And then in the context of global portfolios, America dominates portfolios, so you see that come through. So in actual fact, over the last 12 months, the non-American markets and the Australian market have traded broadly similarly. It's very much been people want to own American assets and they don't really want to own other assets. And so there's not been a differentiation so far.
Okay. So then let's move on to currency, because I think that's part of the reason that people have been buying up US assets, and it's been a good move. As you've seen, certainly the Australian dollar devalued significantly against the US dollar. How's the Australian dollar been moving against other currencies, and what's Platinum's view about the outlook for the Australian dollar? Yeah,
so we see no reason to own the Australian dollar. So what we get to do in Platinum, we own stocks overseas when we buy a company, say for example we buy shares in Toyota, we're therefore exposed to the yen. We then have to decide what do we want to do with that currency exposure. So we have two decisions. One, can we own a stronger currency? And I guess two, bear in mind that our clients are almost all Australian, therefore we take the Australian dollar into consideration. So at the moment we don't see any reason to own this currency, and in many ways, the end of a resources boom, perhaps a question mark over where this country is going from a strategic perspective. So the countries that we do like around the world, at a country level, generally there's some sense that there's reform taking place, and that there's a need to change, and how that change will play out. I think we've rested on the coattails, if you like, of China. You could argue that our politicians haven't had a crisis to deal with, so they're creating their own, what you would call it, self-promotion, rather than looking after where we might be going forward. But when you look at Australia, we're not saying there's a disaster ahead, but what we're saying is, in a currency context, it's not a currency we see any reason to own. So then when you look outside Australia, and I mentioned Toyota, Japan is a country, again, we don't see any reason to own the currency. They're probably they are the most aggressive printers of money. There is a risk that the confidence is lost in the yen. It's not a prediction, it's a risk, and therefore we don't need to own that currency. Interestingly, China, which is a country we very much like, we also see no reason to be owning that currency either, and the reason is that China's going through a change. We love some of the stocks we can buy there, but the currency is a tool that the government may use if the reforms don't work in the way they want them to. So again, you're kind of managing that risk. Across to Europe, the euro, we're kind of slightly underweight the euro. We hedge some of our euro exposure, and all of that exposure that we're hedging out of at the moment, whether it's not holding our cash in Australia, not owning the yen, not owning some euro, that all goes into the US dollar. So for now, the US is the currency that as you said, many people want to own. We see that as the best place to be. Having our currency exposure, they've pulled back on their money printing, the economy is recovering, and really that's been over the last year, or particularly the last 6 months, the right place to be, and we think it continues to be.
But it's too early, I think, but I'd be interested in your view, to be hedging back so that you're protected against the Australian dollar strengthening from here. I mean, I think your thesis is can't see an argument to own the Australian dollar, so why would you apply hedging?
That's right, and I think what's interesting is when it got to about 85 against the US dollar on the way up, that's when we saw no reason to hedge on the way up. We don't hedge unless we think the currency is undervalued. The most likely scenario is when we think the US dollar's gone far enough, there will be other currencies that are more attractive than the Aussie. Probably the euro, I guess, given the range of options there. And the important thing to remember is, so far, the Aussie hasn't fallen, the US dollar's gone up. So last year, the Aussie went up against the euro, up against the yen, and I think you can take the ski holiday test. So I'm having a debate with my wife at the moment about where we go next year to ski, and she wants to go to America, and I was saying we can go anywhere but America, because Canada, Europe, Japan are all cheaper than they were a year ago, whereas America's got a lot more expensive. So sometimes the simplest things are the most helpful.
So then moving on lastly to what are the real areas of excitement that Platinum sees for an investment?
Okay, so it really comes, the portfolio has been moving more and more to the east, if you like, towards Asia, and particularly China. So if you go back to the middle of 2013, Asia was the smallest continent we were exposed to. We had about 14% of our portfolio there. As of now, we have about 32%. So we've moved about 20% of our portfolio over a year and a half into the Asian markets, and the dominant one within that is China. And I think we can look at it in a number of ways, but one of the things that drives markets are emotions, and there's been a lot of negative emotions around the Chinese stock market. So they've had one of the worst bear markets that we've seen in modern history, and 2/3 of the value in that market was wiped out over 6.5 years in a time when the economy doubled in size. So we've really seen this horrendous experience for those owning Chinese stocks. That tends to put people off. Valuations are at Asian crisis levels, so the valuation suggests we're in the middle of a crisis. What we're really seeing is a change in China, and we think people tend to confuse change and uncertainty with, I guess, it's combined with fear. It's a reason not to own something. So dig beneath the surface what's happening. We've had an investment boom. China's built a lot of infrastructure. They accelerated that around the time of the rest of the world having a financial crisis. That saved Australia from the crisis, but it also saved China from the crisis, more importantly. So you've got to look at China through the lens of the Chinese and where do they want to go. They want to move to a more balanced, domestically driven, consumer-focused economy. Therefore, rather than selling iron ore to the Chinese, the thing now is better off to be a domestic Chinese company servicing Chinese people. So when we build our portfolio in China, it's very much with consumption at the heart of that. In simple terms, China will grow more quickly than any Western economy in the next 5 years, and consumption, as we rebalance, will grow faster than the economy. So in the context of a low-growth world, the Chinese consumer is very exciting. Now that sounds like, well, everyone knows there's 1 billion consumers, but we can buy the leading alcohol brand in China, and this is a company, Guaichou Mutai, which you would think ranks higher than a good quality Scotch in terms of its product. It's the drink that Mao served to Nixon back in the 70s. This is a product, $6 it costs to make a bottle of this stuff, and they sell it for $120 wholesale. So a fantastic business. But we can buy that business for 12 or 13 times earnings, so less than you'd pay for a Telstra or a Commonwealth Bank. And this was the drink of choice when you were bribing a government official. What's happened here is the retail price of Mutai has come back as it's no longer, if you like, safe to bribe an official, and it really becomes that high-end product that you serve on the table at a wedding. So I'm assured at 54% proof it's quite dangerous, but I unfortunately haven't had any of it yet. But, some of my colleagues have.
All right. Well, Douglas, that's given us a really good insight into how Platinum's viewing the world. We'd be delighted if we saw some more double-digit returns coming into the next couple of years. So keep up the good work.
That's great. Thank you very much.
Thanks.